Okay, so the operating cash flow section is weird in the indirect method. Okay. Um, there's a bunch of adjustments that are not intuitive that you're going to have to make. And kind of, I would think, I'm going to try to explain it conceptually. I think at first you're going to forget and like it's not going to be intuitive, but I think the more you think about it and like try to remember what we talked about today, hopefully it will become intuitive. Um, but basically, with the indirect method, we're going to start as a starting point with the net income. Okay. The net income is coming from the income statement. So we're going to have our income statement. We have that net income number, but we know that a lot of this, there's going to be non-cash things that are like kind of baked into the net income. So what we're going to do is start with the net income and just do a bunch of adjustments to it to suss out how much cash was actually transacted. Okay. So, and that's why it's called indirect, because you're starting with this accrual based number, which is net income, and then you're adjusting it to get to the cash flow. And again, this is only for the operating section. Okay. For the investing and the financing, we will just directly look at how much cash was spent in investing and came in through the investing and vice versa. But this indirect method is going to just be for the operating section. So um, the first, uh, and hopefully like obvious, this is kind of illustrating the point, is depreciation, depletion, and amortization expenses. Okay. These are all in the income statement. Do we agree with that? That depreciation expense would have appeared on the income statement? Are we good with that? That's going to have the effect of lowering. Uh, it's a subtraction, right? It's your revenues minus your expenses. So net income is lower the more depreciation you have. Do we agree? Okay, so if we wanted to undo it because it's not a cash expense, right? Because the journal entry would have been depreciation expense, debit, and then what is the credit? This is throwback to chapter 9. Exactly. Yeah. Yeah, you know it. Yes. Yes. Accumulated depreciation. Okay. So there's no cash here, right? This journal entry is non-cash. This expense, of course, is in net income. It's part of that net income number, right? It was used to calculate net income. But since we're trying to get back to cash, we're gonna do an adjustment to net income to account for that. Okay, so what we're gonna do is we're gonna add how much the depreciation expense was. We're gonna add that back to net income because net income, if we're trying to get to a cash flow, we have to adjust it upwards for this non-cash expense. Does that make sense? Yeah. So just to give you a number, let's say we had $100 of revenue. We only had one expense, and assume this revenue is all cash. We're like Costco. Okay, we got $100 of cash. We had one expense, which is depreciation for $50. Our net income is $50, but we want to get back to how much cash flow we brought in. What we're going to do is add this 50 back. Okay. And again, assuming this is all cash, we now have how much cash came in the door. Okay. We're going to see how we adjust revenue later because we know some revenue is not cash also because we have accounts receivable, etc. But again, just to illustrate this single adjustment in isolation, you hopefully you can see now why it's a positive adjustment to cash. Okay, so the next adjustment that you make, so this is the first, this is going to kind of be the first. In real companies, depreciation is the first, and usually it's stock-based compensation is second. Because the journal entry for stock-based compensation, when you give your employees stock, is whatever salary expense, and then you're going to usually credit like paid in capital. So this is again non-cash. You're basically saying in this journal entry that your workers have traded their labor for stock. That value of labor, let's say this is 100K. Let's say you have some worker that has a salary of $100,000. You're saying that their labor is worth $100,000 for the year. Instead of giving cash, they're contributing that labor and getting capital. They're getting stock in exchange for that. But there was no cash that happened here, right? So that's another, we're going to see it. I'll show you guys a real um, section of this, but that's like another, that's probably the second adjustment you'll see is adding back stock-based compensation expense. But in the book, they don't have it, okay? In your homeworks and stuff, they're not going to, stock-based compensation is not really covered in this class. So it's not in the book, but I'm just telling you in the real world, when we see it, that's usually the second one. Okay, and then uh, next is gain or loss on the sale of disposal of long-term assets. Now, within net income, if you remember when we were calculating if we had a gain or loss on the sale of an asset, um, the gain was going to be in the income statement as a other income, right? So this net income is including that gain on sale of your plant asset. But since we want to have all the cash flows related to investing activities and assets in that section, we're going to kind of adjust it out of net income because we want net income to just be the stuff, all the cash flow just from operating the regular operations of the business. And we consider like the gain on sale of your tractor is just a one-time thing. Okay. So we're going to take it out of net income. It's going to reappear though in the investing section, but we're going to at first take it out of net income because again, this is our starting point. So we have to kind of clean it up. Okay. So whatever the gain or loss on the sale of the long-term asset was, it's going to depend. If it was a gain, that would have increased net income. So we need to make that a negative adjustment. If it was a loss, that would have decreased net income. So we're going to have to add that back. Okay. So it will depend on the circumstance, whether it's a gain or loss, what the adjustment is exactly. And then I'd say this is the most complicated part of these adjustments. Okay. You're going to then adjust the changes in your current assets and current liabilities. Okay, now I'm going to go into more detail about this, but accounts receivable, inventory, um, they're going to change during the period. And the change in those accounts is going to help you reconcile to cash. And I'll show you, we're going to talk about this in detail, but this is definitely the most confusing set of adjustments. Current liabilities, accounts payable, unearned revenue. These are also, we're going to see how they changed between the period. And based on that change, it will help us figure out how much, in the case of these current assets, we'll just see how this works. But basically, when a current asset increases, as you can see here, increase in current asset, it's going to be a negative adjustment to cash. If there's an increase in a current liability, it's the opposite. It's a positive adjustment to cash. When a current asset decreases, it means there's a positive adjustment. When there's a decrease in current liability, it's a negative adjustment. Now, why this is the case, we're going to spend some time.